let's jump right in. So thanks everyone for joining live. If you're here live, if you're watching the recording, for joining us. I am Jordan Fry from the Prudent Plastic Surgeon. Very excited to be joined here by Michael and Vera from FPL Capital Management. And we got introduced a while back and have kind of been having this ongoing conversation behind the scenes of like, okay, once you get the basics in terms of wealth management and wealth building and stuff like that for physicians and high income earners, what's kind of the next step? Like I just said, what can you do to kind of twist the dial, just tweak it a little bit more in your favor? And so that's kind of what I set out as their marching orders, is like, let's talk about those things. And so that's exactly what they're going to do. And nobody better. Michael is the founder, the manager at FPL. Veer is the chief compliance officer, and he runs all the retirement accounts and everything like that. So you really couldn't have two better people to talk to about it. In my discussions with them, they're incredibly thoughtful and detailed about everything. So I'm very excited for this conversation. Like I said, our goal is to keep it casual, just like a discussion as if we were having drinks. So we'll go through the PowerPoint and everything like that. But kind of after every section, we're going to stop and have a discussion. So certainly, if there's questions you have, I encourage you, feel free to unmute and put your camera on and ask that way. If you feel more comfortable, just send them into the chat and I'll ask them. But we really want this to be super interactive. So I encourage you to take advantage of the time we have with these guys. And without further ado, let's get started. So I'll let you guys take it away.
Okay. Thank you, Jordan. V, do you want to get started?
Yeah, so as Jordan mentioned, we wanted to get beyond some of the basic stuff and some advanced strategies to use when it comes to preserving your wealth and minimizing taxes. So, one of the main topics we always see are backdoor Roth conversions, and it's a very basic topic. So we're trying to go a little bit beyond that, and we're going to talk a little bit more about Roth conversion planning. And I'll let Michael start off here and continue on with these topics.
Yeah, I'm gonna try to. There's a lot of good stuff that is in the presentation towards the back end, so I don't want to spend too much time on this, but I do want to hit on these, and I love the idea of opening up for Q&A. I think that's the best way for people to get the most out of information that we have. I'm sure everybody who's listening to this is familiar with the whole concept of a Roth and whether they should do it or not. I think everybody wants to have a Roth. The biggest question that they always challenge with is, if I do the Roth, then I don't get the tax deduction, okay? Or if I do a conversion, it's going to cost me an arm and a leg in the conversion of paying the tax. So just a handful of things that are just very much, I think, kind of like no-brainers that people ought to be thinking about. And that is, Roth is powerful. It's going to grow tax-free. The one thing that a lot of our clients run into is they have so much money in retirement money because they've been contributing to 401k since the 1980s, and they're retiring with millions of dollars. So when they retire, even if they don't need the money, they're taking out an RMD. They're taking out $300,000, $400,000, $500,000 a year just as an RMD, required minimum distribution, and you're getting taxed. So this idea that, oh, when I'm retired, I'm going to be in a lower tax bracket, not always the case. Not for affluent people, and not for people that have been putting a lot of money in retirement accounts for many, many years. So you really need to start looking at putting money into Roths. How do you do it? Number one is, you can do conversions. When's the best time to do a conversion? When the markets are down 30%, 40%. People say, oh, well, how often does that happen? Well, in the last 6.5 years, we've had 3 times that the markets have been down, over 22%. So if you have that opportunity, like in 08, 09, if you have, the pandemic, you have the 2022 with interest rates, you have the sell-off with the tariffs, you've had opportunities. That's a good opportunity to convert some of your IRA money to a Roth when the markets are down. Aside from the most obvious is, if you think that you're going to be in a lower income tax bracket, then that makes sense too. Like, if I'm going to be retired, I'm not going to be having to take my RMD. I'm not going to have any income. Let me look at, and you work with your CPA, find that sweet spot on your tax brackets where you can do some conversions to where it's not putting you into a higher tax bracket. Okay. The before Social Security, where you before you have extra income. And of course, the biggest thing that I'm going to say is in your current plan today, and this is different than it was 10 years ago. 10 years ago, you had very few 401k plans had Roth options. Today, a lot, I think a lot, I don't know what Vijay's the expert in 401ks, he'd know the answer to this, but most 401k plans allow for a 401k, a Roth 401k. My recommendation is do it. You're elected deferral. If you're putting away your $23,000 or $30,000 a year, do it in a Roth, bite the bullet, pay the taxes, let it grow tax free. And then if you're in private practice, you're doing profit sharing, let your profit sharing be where you get your tax deduction. So when it's all said and done, you're getting to an environment where, like a third of your contribution is Roth, 2/3 you're getting your tax deduction. I find that to be a really good mix. Okay. Another kind of thing to think about is we've established that it's good to have money in Roth. A couple of things about this is, and a lot of people know this, it's an elephant in the room some people don't think about. Most of our clients are not going to die with bouncing their last check. Okay. They're going to have money. They're leaving money to your kids. Okay. If you're going to leave money to your kids right now, the way that the IRS is with an inherited IRA is your heirs have to pull that money out within 10 years. So now let's just fast forward what this looks like. You don't use all your money. You leave, $5 million, $4 million in an IRA to your child. They have to take it out over 10 years. They're literally going, let's say just use a number like $4 million. If they're going to take it out over 10 years and they're doing like equally breaked out, periods, they're looking at, and there's growth to that portfolio. They're looking at probably taking out, $600,000 a year in doing that. If they did a little bit every year. The other option is you take it all out in year one, which doesn't make sense because now you're getting hit with a $4 million tax bill. If you wait 10 years, that doesn't make sense because now it's grown. You're getting hit with a $10 million taxable income. Taking a little bit every year probably makes the most sense. What really makes even more sense is don't leave your kids $4 million that they have to take out over 10 years in a 401k rollover, IRA rollover. Try to give them to his Roth money. Okay. Now, how do you do that? Well, it's real simple. Is start doing some of these conversions. And here's the thing: the Roth is the last money you're ever going to touch. Like, so if you have Roth money, you got IRA money. You're retired, you don't touch the Roth, you pull out from your retirement, you pull out from your retirement, pull out from the IRA, pull out from the IRA, and then you keep your Roth money to the end with the idea that when you die, all you have left is Roth money. That's what you leave, to the kids. One of the other ideas behind this is if let's say that you get to a point where you have 1/3 of your money is in a Roth and 2/3 of your money is in an IRA, you're retired, you're taking your RMD, take your RMD, you're not taking from your Roth IRA. Over time, the Roth is going to become a bigger and bigger percentage of what you have, to where then, let's say you pass away with $4 million, but half of it's in Roth, half of it's in an IRA. So it makes that smooth transition without you having to make that big commitment of saying, hey, I'm going to take a big tax hit in a given calendar year. And of course, if you plan on giving away plan on donating, making a big donation in a given year, that's another opportunity. You're donating something like appreciated assets, but then you can say, okay, this is gonna, I can offset some of my taxable income. This is a year where I'm going to do, an above average Roth contribution because of it. It's going to increase my taxable income. Okay. Vijay, did you want to do Q&A after this section or?
Yeah, I believe Jordan, we're gonna pause for some questions.
Yeah, let's plan to do that. First, which is just a minor thing that got brought up, is there any way you could enlarge this screen at all or like zoom in a little bit? That was just one request. Yeah, perfect. So what I'll do, definitely send in your questions if you have them. I guess one of the things that I hear a lot, and maybe you could go a little bit deeper into, Michael, is like that So in your mind, like the one third, two third, that's kind of what general rule of thumb. Sorry, I have a dog and a cat fighting here. Um, is that kind of a good rule of thumb in terms of how to proportion things? Because I see a lot of people fretting about like, well, how much do I convert, and making that decision seems to be where a lot of hangups are.
Yeah. We like it. And how we kind of developed into that concept is a lot of our clients are contributing. They have the profit sharing, they're maxing out profit sharing. They're also doing the elective deferral. Is when you look in those, if you're using those metrics, about a third of your money is the deferral, the
Mhm.
employee deferral, and two-thirds is your profit sharing. So that gets you, about that one third, two-thirds. But the idea behind that is if they're invested, in the same investment strategy over time, then it's going to grow at the same rate,
Mhm.
so that's what you're stuck with, right? Also at the same time, that's an assumption that's really not necessarily a good one, because the reality is and what we recommend to everybody is that you have uh, uh, your most aggressive investments
Portion,
in
yeah.
a Roth, so that they're growing at a higher rate than the rest of your portfolio.
Hmm.
But we do like the third versus two-thirds, just because, like I said, it gives you a third. But when you do start pulling out your RMD, you could organically grow that Roth to where it becomes a much larger percentage.
Okay, makes a lot of sense. Um, One question coming in, could you kind of talk a little bit more, you did at the end, about how setting up a DAF, like a donor advised fund, uh, fit into wealth planning?
Into wealth planning, or with the Roth conversion.
It's wealth planning in general.
Okay. Well, I mean, it's if you are going to we like the DFAs are fine, or a lot of times we have clients that are donating just to their, like, a private foundation. The idea behind that is that rather than donate your $10,000 a year, okay, which if that's your consistent thing you do, why not donate $100,000 in a given year of an appreciated asset? Like, let's say you had, stock that went up that you're looking to sell or to rebalance, and rather than sell it and take the capital gain, um, you could go ahead and donate that to a D, to a DAF, or to a foundation. But you can donate a big chunk of it to where you take that big tax deduction. So the benefit of the DAF is that it gives you the ability to get that big write off in one calendar year, versus spreading it out over time. So it is a very effective strategy. And I think the bigger issue is when you have the appreciated stock, especially if you have something that you got, very, very low, that you've owned. Like if you're lucky enough to buy Nvidia, 10 years ago,
Yeah.
and yeah.
Um, okay, awesome. Emilio has a question. So for Roth conversion, if you have significant IRAs and Roth IRA, saying his is approximately 50/50, it sounds traditional IRA and Roth IRA. Um, is doing that, they're saying backdoor Roth not prudent because of the pro rata rule, but that's different than the Roth conversion. So maybe you can kind of shed some light on that differentiation.
Yeah, well, you should never. We never do if you're going to get hit with a pro rata, then no, you don't want to do that. If you're converting where it's that one portfolio, you're doing the whole thing. If you're talking about, let's say, like the backdoor Roth, okay, the backdoor Roth is a problem people have. If you have IRA money and you're trying to do the backdoor Roth, then that is problematic, because you got the pro rata rule.
Hmm.
In that particular case, in our opinion, is forget about doing the backdoor Roth. Just every year convert some of your IRA. Do 10,000 a year, 15,000 a year, out of your IRA, instead of dealing with the headache of the pro rata.
Hmm.
That makes more sense. And now once you have money that's in qualified plans and you don't have to worry about the pro rata rule, then everybody should be doing a backdoor Roth, if you can. Everybody. It doesn't make sense not to. At least for people that are like physicians that are making a good living, is do your $7,000 a year absolutely, into a backdoor Roth if you can. If you can't, because of IRAs you have for the pro rata rule, then you may want to just every year convert some of your IRA. So it's almost like the equivalent of doing a backdoor Roth, you do your 7,000, or if you want to do a little bit more, you still are able to chisel away and build up your Roth account at that point.
Yeah. And just again to be super clear, like the backdoor Roth IRA, that's something you can do every year. Like people will call it the legal loophole, contribute into your traditional IRA, convert it into a Roth. You're allowed to do up to 7,000 for you and your spouse every year. And then a Roth conversion, slightly different just in the sense there's not necessarily that cap of $7,000, and that's taking like basically pre-tax money that you've contributed to a retirement account and converting it now to post-tax. And so you have to pay the tax on that. So just where that kind of got conflated a little bit. Kareem, question, is it wise to do Roth conversions regularly over a period of time prior to retirement versus like like a lump sum all at once?
Well, I think it depends on your age, and also depends what your tax bracket is. Also depends if you think you're going to be in a better position. But I think the answer is that if you don't have, we talked about that percentage. If you have a third in Roth, I think one of your listeners said he's at 50-50. If you're at 50-50, you're doing great. Okay. But if you don't have a whole lot in Roth and you're trying to increase your Roth allocation, then yeah, you should be doing some overtime. I believe, because especially what you want to do is look at how it affects your tax bracket. If you're able to do it without pushing you into a higher bracket, it makes sense. But also, like I said, the opportunistic fact is, like, if you are going to do a conversion, like, follow the markets. If you're a long-term investor and you're going to stay in the market, then think about it. If the markets are down 10, 15, 20%, and you're wanting to do some Roth conversions, like, that's a time when, think about the benefit you get from it. You're literally getting 20. If the markets are down, 10 or 15%, you're getting, to put 10 or 15% more money into the account without it causing that much more tax.
Yeah.
Yeah.
And then last question, I think we'll move on to our next topic after. Ricky's kind of confirming. So in Emilio's situation, talking about like the 50-50 and the pro rata rule, if he can roll over that money in the traditional IRA to, let's say, like a work 401k or 403b, and then eliminate the pro rata in that way, correct?
Okay, well, yes, that is true. Yes, if you can roll it into a qualified plan, then you're going to be fine. So that would make a lot of sense. But as long as your qualified plan that you have is a decent plan,
Right.
right? Because you don't want to be going into
Right.
a mediocre plan just because. And this is the big one. I'm going to say that the old saying, "Don't step over a dollar to pick up a dime." Okay.
Yeah.
And what I mean by that is, it's if you're going into a plan that has high fees, low choices of investments, then but why? To get that extra $7,000 a year, how much is that really moving the needle?
Yeah, that's a great qualifying point. All right. Well, let's move on to our next topic. And then Ravish, yes, this is being recorded and we will send the recording out to everyone. So yes.
I guess that kind of leads us to the next related topic about 401k plans for physicians who actually own their own businesses. Michael touched upon a little bit about on maximizing your 401k contributions, and currently with the regular Roth IRA you only get about $8,000 put in. Yeah, with the catch up, with the 401k Roth, you could get up to 24,500 plus 8,000 catch up, well north of $30,000 per year. So that's one of the I think missing parts of most people's portfolio, that they don't have access to 401ks. Ones that do, one of the common problems we see is that most plans that practices have, they're usually a cookie cutter basic plan that really doesn't have too much plan design included in it. While Roth 401k may be an option, there are other issues with these cookie cutter plans that we typically see. Owners not able to max out their contributions, very underperforming, non-diversified investments, high expense ratios of commission products. Typically don't see self-directed brokerage accounts in these 401k plans, which is a very key aspect if you look into access investments that are outside of, a dedicated 401k investment menu. And another common issue we see is asset-based fees versus flat fees, which means that every time you contribute your paycheck every 2 years, 2 weeks, you're paying a percentage of your assets directly into the provider's hands. And that can have a great negative impact, when it comes to compounded growth. That's a huge, issue that we typically see. Another thing is that these cookie cutter plans that we see typically have, they start off with, basic plan design that's not really scalable as businesses expand and grow. So that's, many things to consider when it comes to entry-level plan design services that a lot of these 401k plans receive. And if you go to the next, the key objective in these 401k plans is that to optimize taxes and increase retirement benefits. If you don't have a robust plan that's, with customized plan design, you're going to have limitations on what you can contribute and how you save on taxes. Those are, items you should definitely look into. And the other issues that we see are low cost and high quality investments, which you should have access to 401k plans. And these days you're seeing a lot of low performing, high expense ratio funds that could quite affect your retirement outcome. And that's why I think having a self-directed brokerage account makes a lot of sense, which can allow you to have private fund access, which is something we're going to touch upon a little bit later on. And make sure that all this plan design and investments are scalable as you grow. That's what I kind of have on the 401k plan. So Jordan, if you want to do the Q&A and.
Yeah, perfect. I guess, can you speak to some of the asset protection that 401k plans provide compared to other types and sort of the benefits that are there?
Yeah, so 401k plans probably have the best asset protection compared to most retirement accounts, such as IRAs, Roths, and Simples. It's an unlimited protection with 401k assets because they're ERISA protected. And these are with IRAs, you're limited to what the state limitations are, which is about 1.3 million, and there's some flexibility. It varies by state sometimes, but the average of use protection is 1.3. With 401ks, you pretty much have unlimited protection.
Okay. That is a super important point. Awesome. Some related, Ricky's asking, this is a little bit about sort of like business design and stuff like that. But around what 1099 income, if I'm self-employed, do you start coming out ahead tax-wise, whether making an S corp or a sole proprietor structure, 300K, 400K?
Sorry, repeat that question again.
So Ricky's asking kind of like around what 1099 income does it start making sense to structure yourself or your business as an S corp versus a sole proprietor?
So with if you're sole proprietor and you don't have any of the employees, it's a S corp and LLC. The income is probably, you could go as high as 350 if that's what the question is.
Okay.
Yeah.
I think
Yeah, I mean, with something like that, I mean, that's kind of a CPA question, but the reality is, there may not be any difference if you're doing it correctly. There's still, even with a sole proprietor, you can still get a lot of the same write-offs as an S corp. And that's really what they're really asking is, I think this is what Ricky's asking is like, where can I get the most deductions? Is what they basically are asking, right?
Yeah. And I think,
the thing is, I mean, you could do retirement plans and max out in both scenarios, right, VG?
Right, you can. With solo 401k plans, you have a lot more flexibility than you would do if you had employees. So the deductions are, as large as you can make it be within the IRS limits, obviously.
okay.
Yeah. One thing about solo 401ks I wanted to mention is that solo 401ks are not ERISA protected. So they don't have the same asset protection a group ERISA plan would. So solo 401k protection is based, it's almost similar to the IRA protection, which is based on state limits.
Okay. Um, Emilio has another question about a situation, which is so he's leaving his W-2 job where he has an employer-sponsored Roth 401k plan, and he's going to be doing locums work as an S corp. So would it make sense to start a solo 401k, roll over his Roth 401k into the solo, um, or can roll over to his traditional IRA into the solo 401k? So I don't know even it's kind of a lot of nuance in there. But Emilio, if you want to come on and sort of uh, ask Michael and VG directly, because I think those are very important points and would help kind of illustrate the whole situation.
Yeah, the question I don't know, Jordan, is Ricky suggested above in the chat rolling over money in the traditional IRA
Right.
to the work 401k. I hadn't thought about that, so that's one question. And Ricky was saying, would that eliminate the pro rata rule? I don't know if there's any easy way of getting, the answer is probably not, of getting traditional IRA funds, because like I was saying, 50-50, I don't know my exact numbers, but I'm just
Yeah.
making this up.
Yeah.
Let's say that if I have a million or 2 million in traditional IRA and a million or 2 million in Roth IRA, and this is a different question going back to that whole backdoor Roth. I think we all agreed that it's probably not a wise thing because of the pro rata rule. And if that's the case, then now if I'm going into, well, first of all, is it wise to do a solo 401k if I'm going into locums as an S corp, to establish that and then be able to put in uh, my Roth contributions while the S corp puts in the profit sharing contributions in a I don't know, could they do that in a pre-tax? I mean, of course they could do that in a pre-tax, but could the S corp put in post-tax, probably not Roth
Yeah.
contributions? I'm not sure.
Yeah, so there is what they call after-tax contributions, which is in addition to your Roth 401k deferrals. So what happens is that once you reach the maximum limit on your Roth 401k deferrals, which, if you're over the age of 50, that could be high as $32,000. The remainder can be made in after-tax contributions, which you immediately convert into Roth buckets. So which ends up being, pretty much what they call a mega backdoor Roth. And mega backdoor Roth is only feasible, you know, expense-wise, in a solo 401k situation. If you have employees, it becomes very convoluted and expensive to do. But in a solo 401k situation, that's definitely an option. And I think Michael will agree for our individual clients who don't have employees who have solo practices. We think solo 401k is the best type of investment vehicle you can ever have because of the flexibility it offers, the protection it offers when it comes to the pro rata rule, and also doing the mega backdoor Roth conversion as I just mentioned. We feel
Can,
like
can,
solo 401k is one of the best features you can have, best
can,
account types you can have.
can you just briefly define that mega backdoor Roth, what you're doing, the steps that you're doing?
So what's happening is that we have two buckets of money, right? You have the salary portion of your the employee portion of your contributions in a 401k, right? And there's the employer portion of the contributions. So you can do the employee portion, for what they call a 401k Roth 401k deferral, which could be high as 32,000. But you still have about 45,000 left in the employer side you could make, which most typical plans will make that in what they call a profit sharing pre-tax way, where you could get the deduction. That is not the only way to doing it. You could also do what they call after-tax contributions, where you're not getting the deduction. It goes into what they call an after-tax bucket. Once it goes in, you immediately convert that into a Roth 401k, Roth IRA, and there you go. You have Roth assets now.
And that after-tax bucket is coming from the employer, theoretically, from the S.
Correct. Yes. Yes. That portion is coming from the employer side. Yeah.
Okay. And the fact that I have outside of all of this, I have just traditional IRAs. Does that play a factor in any of this insofar as pro rata rule type stuff?
Not in that situation because it's within the 401k plan, a
Okay.
qualified plan.
Okay.
But if you were to have a simple outstanding and you're trying to do a backdoor Roth conversion or SEP, then the pro rata rule definitely would apply in that backdoor Roth conversion. You would do it outside of the 401k plan.
Okay. All right. Thank you. Thank you very
Mhm.
much.
Awesome. No, I think that was super helpful just to even go through and that kind of hit all of the different aspects. Um, just to kind of put a bow on this, and Joseph had a comment after that of saying, I believe you or someone you'd be able to set up a defined benefit plan in an S corp or LLC and shelter almost all of your income if you're the sole employee. Can you guys, Michael and Vijay, just kind of comment on that briefly, and then we'll move on to our next kind of topic.
It's not all your income. There are limits, depending on your age and your previous income streams. And ideally for solo practices, it's usually a cash balance plan, which is a type of defined benefit plan. But depending on your age, you can get as much as right now for 2026 across both the 401k, profit sharing, and cash balance about, you know, 370 to $400,000 a year into it. Obviously, older you are, the more you can get in there. If you're younger, that number kind of gets lowered. But anybody aged over the age of 40, you're looking at about 165 across all three buckets of money going into a retirement plan.
Pretty good. All right, perfect. Well, why don't we move on to our next topic and then we'll chat some more.
Okay, Michael.
What's that? Okay. Yep. Before you hit into this, just one thing that BG mentioned, just because I think it's important that everybody who's listening, thinks about this one, is he mentioned about the self-directed brokerage account. Today, so many 401k plans offer the self-directed brokerage account, and a lot of people don't take advantage of it. They don't even know it's an option for them, but it's 99% of the time it's a good deal because you pretty much establish a brokerage account in your retirement plan, your 401k, that allows you to invest in any type of investment that is in a that you can do in a brokerage account, like any kind of mutual fund, stock, ETF. So if you're interested in different types of funds, you're not just locked into that finite universe that you have on that 401k lineup. You pretty much can invest in any fund you want, just like an IRA, and I think that's pretty powerful. And I'm surprised a lot of times how many physicians are not taking advantage of that and don't have a self-directed brokerage account. They're just sticking with the bread and butter of whatever their 401k plan is offering them.
And you know what, actually, before we even move on, just because it's about that, we had a question. So someone interested in a self-directed 401k, any thoughts on converting a current traditional solo 401k into self-directed?
Solo 401k should be pretty much self-directed. Uh, it's
Yeah.
single
Yeah.
brokerage account, so I'm not following the question on that.
Yeah, I don't know what they mean by how self-directed is different than a solo 401k.
Yeah,
Okay.
solo 401k single participant. Usually the owner or the owner spouse, and it's one brokerage account which is self-directed.
Okay. Well, I'll leave that if there's a follow-up or clarifying or
I think even though it's not my question, I think maybe the question has to do with the fact that solo 401ks, it depends who you're setting it up through. Like one thing I'm researching right now is kind of interesting that this seminar, this webinar is the same days. And this is just AI research, so it may not, I'm trying to double check and confirm. But in the past, I've used the company Paychex as payroll. And I was researching it on AI, and they're saying that don't set up a solo 401k through Paychex because their formats are basically what these gentlemen said earlier, that they have these cookie cutter formats, and they don't allow, theoretically, I can't attest to this yet because I'm waiting to hear back from Paychex, but they don't allow for self-direction, and they have fees, fees, AUM fees, et cetera, that you should go to these inexpensive brokerage accounts, such as Fidelity and Schwab and things like that, where you don't have the fees, and they allow true self-direction where you can invest in anything. So I'm assuming that's probably where this question is coming from.
Yeah, I mean, look, if Paychex and ADP is offering you any kind of a brokerage account, run as fast as you can. The only thing they do well is payroll, and that's the only thing they should be used for, to be honest. But if you're looking to get a self-directed solo 401k, those are not the only option. You can open one at Fidelity, Schwab, wherever the discount brokerage firm you want to use it at. The key aspect is using a TPA to administer that, which costs about $1,500 a year, but they allow a lot of flexibility and customization that allows after-tax contribution, that allows you access to private funds. You could create certain sub accounts. That's where the value comes in. It's not using, once again, going back to the previous slide, a cookie cutter offering. It's matter of using a TPA, a third party administrator who could do all that work for you and fully customize that. At that point, it does become self-directed. So, and that's what we see typically. We don't have, like, just Amelia mentioned, we don't have any clients of ours or anybody that we know that use a company like Paychex or ADP for self-directed accounts. You typically want to use an independent third-party administrator to administer the plan, and which costs you about $1,500 a year, depending on if you had a cash balance plan or not.
But that TPA is not coming through Fidelity or Schwab.
No. So you have two providers there, right? The Fidelity or Schwab holds the assets. The TPA does all the plan document work for you, and you yourself manage the account, or you can hire an advisor to manage the account. So that's kind of how that setup works.
And how do you find the TPA?
We can put you in touch with somebody at a company called Emparian. They're quite cost effective, and their main focus is solo 401ks and solo cash balance plans.
Okay. How do you spell that? I didn't catch the name.
Emparion, Emparion. I can, if you want to reach out to me, I can put you in touch with my contact over there.
Yeah, that's actually the best thing to do is VG has a network that he works with, and he can forward those to you. Or you can go to his website, iq401k.com.
Yeah.
iq401k.com.
Okay, thank you.
Awesome. Thank you for clarifying all that and going over that. All right, Michael, take it off.
Okay, so I know I know we're running short on time, and I want to make sure we can cover some things. So I'm not going to go into too deep on this, just because I know that's a broad topic. The topic for today was some of the things that some of our affluent physician clients are doing, and a lot of them are invested in private real estate. But the reality is, it's more than just the private real estate. It's what we're seeing is it's the private markets. Okay, it's not just private real estate. It's anything that is not necessarily the stock market. It's private equity, private credit, private infrastructure, and private real estate. It's the pervasiveness of investing in the private markets, where there's this more dependability of return and potentially better returns, excess returns with lower volatility. And that's really the thing that people need to be looking outside the box. This idea of the old 60-40 portfolio, that's old school thinking, and it's honest to God, it's not what wealthy people do. They have very little money in fixed income. You're going to focus on other things. So real estate's been a very hot topic, because in recent years, go back 5-10 years ago, it was doing very, very well. The last couple of years have been a little bit rough, but historically, real estate's a great place to be, because the returns are consistent. There's good cash flow, good income. So if you're looking for something that consistently give you a long-term return of 8 to 10%, and it's not a bad place to be. And of course, not dealing with the volatility of the market. So private real estate is something good to look at. Here we're talking about direct ownership versus the private funds. I don't want to get too much in the weeds on this. I think everybody knows, if I buy a piece of property, you have great opportunity of getting returns when you're buying something, because you have the ability to do leverage. You can buy $1 million property with $200,000 down and get great return on your money if you're working off of a good cap rate, if you're going to sell it later. So you can get really good returns by the direct ownership. But for a lot of people, they don't want the hassle of that. They don't want to have to look for the deal. They don't want to have the hassle of the logistics. They don't want to have to do up the financing. They don't want to have to follow up on whatever work is needed on the property. They just want to have an exposure to that. And there are plenty of really good real estate companies out there that are diversified. The big thing you have to handle is is understand that real estate, like every other major asset class, is going to have a spectrum of types of assets. So just like in the stock market, you have your core holdings, which are going to be very conservative, and then you're going to have on the on the other end of the spectrum the more volatile type of investments with a higher expected return, but also higher volatility. Same thing with real estate. On one end, you have core properties that are fully, developed, rented, leased, have good predictability, and on the other end, you actually have more of like the development side of things. So in that particular case, it's, which one is best for you depends on the client, depends on where you are in life, what you're looking for. A lot of our clients, they have money in both. And what they'll do is if they're younger, they're plowing money into maybe some of the development projects. But then when those fully get realized and developed and they're sold and they realize that gain, they'll then roll that money into a core development, a core type of fund that is more of the conservative. So on the diversified core properties, you're looking at funds that'll throw off dividends that are 5 to 6% on their dividend yield, but have price appreciation of 3 to 5% a year. Very consistent returns. If you are somebody who owns property, and I think somebody mentioned this, I think earlier in one of the questions, or maybe not, it was if you're looking to sell something and invest it, there's always the ability of doing like 1031 exchanges where, hey, I have this property, I've owned it for a long period of time. And here's the big thing. People forget about this. Oh, I paid this much for it, but then they forget that they depreciated it over the last 15 years or 20 years. Okay. So now your adjusted cost basis is really, really low. Okay. And you want to sell it, you're going to get hit with a big tax bill. You're going to get hit with depreciation recapture. In that particular case, that there is an advantage. Could you sell and do a 1031? Yes, then you have to go through the identifying the property. There are some real estate investments out there, some companies out there. There are a couple. I'll throw a couple names at you. One that we really like that we do a lot of business with. Maybe your listeners have heard of them. Origin out of Chicago. They do a very good job. They have a really good 1031 program. You sell a property, it gets invested into a DST. They hold on to it for a couple years there, and then that DST gets rolled into their core fund. And then once it's there, you hold on to it for a year. And then after that, if you want to sell it, you can sell it or sell part of your investment, or you can just leave it there and have it continually be invested in that fund. You do something like that, then you'll avoid having to pay any tax for selling that property, and you've now rolled it into something that's a core property, a core holding that can actually be a very long-term kind of legacy play for you. At the same time, and we're talking about like the private real estate funds that are available. If somebody was asking before about donating or appreciated stock, is if you're looking to sell, one of the good things, and this is effective starting January 1st of 2027, is the new version of QOZ funds, qualified opportunity zones, where if you realize a capital gain and you don't want to pay the tax, you want it to be deferred, you can invest in a QOZ fund that invests in real estate development. You hold on to it for 10 years. That's going to grow tax-free. Those are things worth looking at if you're interested in real estate. Okay. I'm looking at the questions here. Liquidity, that's a really good one. Is the one thing about the funds is if you have good liquidity, like some of the funds I mentioned, the Origin Fund, every quarter you can put a request in to pull your money out. We have big positions in like Blackstone's real estate fund, BREIT. Every month you can put your request in to receive money. So liquidity is definitely an advantage you have with these funds versus owning individual property. Does your yeah, I mean, I think I covered all of those areas. I mean, when you're in the fund, you're getting the diversification, the scalability. I mean, the one thing, like I'll give you this, is you talk about scalability, and I don't know about your constituent base, Jordan, of listeners, but I know a lot of people invest in multifamily. You know, you hear that a lot. Okay.
Yep.
And that's great. Multifamily is a great asset class, long-term, not long-term multifamily has the lowest standard deviation of any of the major of the real estate asset classes. It's conservative, and it always has been. You know, people always need a place to live, so multifamily is fine. But at the same time, there's a lot of other assets out there that are worth investing in that are part of like this new paradigm. I'll give you a perfect example of that, and it's like with if you look at going with a big fund that's diversified, like Blackstone, for example. One of the biggest allocations they have in their portfolio today is investments in data centers. And there's been and everybody knows there's this huge explosion, you know, to investing in data centers all over the world, and the highest concentration of data centers is actually in the United States. So and of course Blackstone has investments in these data centers not just in the United States but also globally. You're not doing that on your own. That's not a deal where you're buying. And it's also not a deal you're doing with if you're going with some real estate sponsor who has some syndicated deal and they have $100 million fund or something like that. They're not getting there either. You know, so there isn't a, you know, you want to do some individual, that's fine. But if you really want to have large allocations of money allocated to the private markets, in this case, we're talking about private real estate, you want to be in very diversified funds with well-established institutional type of partners. And that's kind of what you see here with like Blackstone, for example.
Okay. That was fantastic. I want, just in the interest of time, because this is our next topic is something that I don't think many are familiar with, and it's certainly something I wasn't until learning about it, and I'm continuing to learn about it. So, Michael, why don't you just jump right into this PPLI?
Yeah, I'll try to make this quick within our time allotment. But the reality is, Jordan, like this is a growing topic among affluent individuals, and this is the one you could probably have an entire
an hour on this.
On this one, yeah. And if you decide to do that, I have experts in this area that I can introduce you to that you can bring into it, okay, to talk about. But private placement life insurance, I guess, make this really, really quick. It's kind of like I think most of your listeners are probably familiar with all types of insurance, like universal life, variable universal life. This basically, you go back, this is like the better version of a VUL policy, okay, in the sense of being able to have similar characteristics of the investments. But the reality is this about PPLI is, for the longest time, like the minimum to even do this was like $10 million, the minimum. A lot's changed, and this is why it's becoming more and more of a topic today than it was 5 or 10 years ago. Now you can get into this for as little as $1 million investment in this. But the main reason that people invest in the PPLI, it's not really because they want the insurance, because what it really is it's they're paying for having money grow tax-free, and they're paying a little bit of money to have that advantage of money growing tax-free. The one thing, I hate insurance. I hate insurance companies. I mean, I actually I would save a lot of money if I just refused to pay insurance 1 year. Okay, I hate them. I'm not a big fan of insurance, but you know, you need it for certain things. If you need life insurance, buy some term life. But when it comes to things like estate planning, it's worth looking at some of these types of policies. But what's great about PPLI, the design of it is to create an investment vehicle that buys as little insurance as needed by law. Okay, that when you invest in a policy, it's not about you getting the life insurance benefit, right? Okay, it's not about you. I need 2 million, 3 million, 4 million in coverage. I'm looking to shelter as much money as possible to grow tax-free over the next 10, 20, 30, 40 years, or for the rest of my life. And I don't want to pay tax on it, and I don't want to pay tax on it, period. And I either want to be able to pull it out and not pay tax on it, or I want to leave it to my estate and they don't pay tax on it. Okay. But in order to benefit from it being a vehicle, you know, that's the one thing about insurance companies. They're blessed with this advantage of having favorable tax treatment. But the problem is, to get that favorable tax treatment, you have to have some life insurance in it. So that's kind of the design of it. So I think, like, I'll give you just an example. I know we're running tight on time, but like with PPLI, let's say, for example, here are the biggest benefits of it. You invest in it, your money grows tax-free. The lineup of funds is very, very diverse. It's like a 401k. You can go in all these different stock funds, but the biggest advantage is private market funds. They have every type of private market fund, from hedge funds to private real estate to private equity, a lot of private credit. A lot of investments that typically would be, if you invest in these things and have these great returns, they're great returns, but they're tax as ordinary income. Like, for example, hedge funds, you get these great returns, but it's tax as ordinary income. It kills you. Private credit, tax as ordinary income. So you have these things that are not really tax friendly. If they're in a PPLI, you're not paying tax on it. So, for example, let's say you put $1 million in a PPLI policy, and you let it there for the next 20 or 30 years, and it grows, to millions and millions of dollars. Then when you die, your estate's going to get it, your heirs are going to get it. But let's say that you want it. Okay, let's say, hey, you know what? It's like, I got 10 million in this, but I really want to go buy this $3 million, house. You can borrow from it. And the borrow, when I say borrow, okay, they're literally going to sell whatever investment you're in and give you the money, but on paper, it's going to be that you borrowed it. And it's a self-canceling note, which means that then what happens is that when you die, you don't have to pay it back. So that $10 million you have in the PPLI, you just took $3 million out. You didn't pay any tax on it. You went and bought that fancy house, okay, to live in, and then you die. Well, that $10 million PPLI is now worth $7 million. Your heirs are going to get the $7 million tax-free, period, and you're done. And you have this investment, this thing that you borrowed money for, and then you're going to leave them their $3 million house, and however that's going to be handled, stuff up in basis. But the point is, it's all about favorable tax treatment is really what this is about. The people that are investing in this, the wealthy people that are buying this, they're not really doing it for the life insurance. They're doing it as a way of having their money grow tax-free.
That is definitely, like you said, this could be a whole, hour in itself. A couple just quick questions I have, and then we'll go Jay as a question as well. When you do borrow from it, is there an interest rate that's accruing theoretically that is
No,
no.
because it's basically, theoretically, you're borrowing it, let's say 2.75%,
Yeah,
but you're getting 2.75%, so it offsets.
gotcha. Makes sense.
So you're not having to kick anything back in.
I think, like, as I typically think whole life insurance, not a great product, like in an insurance product with poor investment attached to it that's very high fees and stuff like that. So I think then you kind of a little bit get conditioned, like, to see something like PPLI and go like, well, what's the catch? What is the catch?
Yeah, so it's funny you should say it. So one of the companies that we deal with, and I'm going to mention their name if anybody wants to look them up, Winged Keel. They're the insurance broker. That's the one that we use, Winged Keel Group. Okay, and I was talking to the gentleman that we deal with, and we go over all this stuff. I'm like how, like, why are not more people doing this now that you can get in for $1 million versus 10 million,
Mhm.
right? Why are more people not doing this? And he said, I thought this was funny. He said, if it wasn't insurance, everybody would be doing it.
Yeah, yeah,
And I told him, I said, you know what, you need to go trademark that, okay?
yeah,
and see if you can get that as your tagline. But it's true, because we're conditioned, like you, like me. It's like, oh, insurance, you're like, get away from me, But I'll give you an example. I'm looking at like a sample here, just to give you an idea of the dynamics. Now, this is based on a $10 million investment. And by the way, it's funded over like 4 to 5 years. So let's say if you wanted to do $1 million in this, you could do $250,000 a year for 4 years.
for 4 years.
So
Okay.
you're not having to come up with $1 million all at once. But in this case, this was 10 million. So all you got to do is knock a zero off of it if you want to do it to $1 million. But at the end of 20 years, okay, this is a $10 million policy. At the end of 20 years, the death benefit is $35 million. The cash value is $30 million. Okay, now let's do this. Let's just say it was $1 million. So we're going to move the decimal over. Is your death benefit would be $3.5 million. Your cash value is 3 million, right? So that means the amount of money, because remember, we're trying to avoid paying for insurance,
Right.
right? Is you have a $3.5 million life insurance policy, but 3 million is cash value. So you're really only paying for $500,000 worth of life
Of
insurance.
insurance.
So
Yeah.
like in this particular case, and I'm looking here, let me go back to where was that? Is the amount of the life insurance now the amount of the life insurance on this $10 million account was $31,000 for the year, which means if it was a $3 million policy, then that means the amount of money going towards life insurance is $3,000.
Yeah. So it's really an investment with a very small insurance wrap to kind of get that treatment.
That is exactly right.
Okay.
It is an income tax wrapper, is what it is.
Okay.
So you're getting that little benefit of the life insurance, and the only other really fee you have is the insurance company has a fee on it. Okay.
Yeah.
I mean, and the underlying investments, will have their fees just like anything else. But their fee will go down as the account gets, but it starts at 50 basis points and goes down to 27 basis points.
Okay.
So what you're basically think about this, you're paying 50 basis points for something to grow tax free.
Right.
So and I think so in that particular case, if you think about like you're getting a 9% return, after their fee, you're at 8.5%.
Yeah.
Well, I'm sorry, maybe a little. Maybe get insurance. So now you're instead of 8.5, you're 8.4.
Yeah.
Because the insurance is so little, right?
Yeah.
Okay. So you get from a 9%, it's an 8.4%. Okay, but if you have this in a taxable account, what would your return be there if you had to pay tax on those gains?
Yeah, the tax drag on that. Yeah.
I mean, you'd be down to like 4.5%, 5%.
Yeah.
Yeah.
Okay. With this, do you have any control over how your money's invested?
Yeah, This is a kind of a like this is similar to like if you had one of those VUL policies where you pick the funds.
Yeah.
Same
You're
thing.
picking the funds.
You have and you have the ability to pick the funds. Now, where we use it with our clients are coming to us and saying, hey, can you help us? We want to do this. Can you give us the recommendations? And of course, that's what we do. But if somebody doesn't want to use an advisor, then and you want to do it yourself, then yeah, and they have on the mutual funds, you're going to have like the Vanguard Total Stock Market Index if you want just for that portion. But then they have a list of other funds. The Millennium Hedge Fund is available through their platform.
Okay.
I mean, it's one of the best hedge funds with the longest track record out there. There's a lot of good. I mean, Ares, Blackstone, KKR, private credit funds. There's a lot of them out there. That are part of that lineup. So if you're looking at like that consistent 10% return, and you want to grow tax free, those funds are available in a platform like this. Yeah.
Very cool. Emilio has a great question again. Generally, by the time you're at that high net worth, you're a little bit older in age per se. Is that make it any difference in terms of the insurance policy part? Like
yeah, a little. It does. Because the best age for this is most people they're doing this when they have advanced wealth is people more like in their 50s and early 60s. Anything beyond that, you're going to get you do have. I mean, it could depend on what your situation is. It could get a little bit of expensive on how much insurance you're having to buy on the front end. And I'll give you an example of this. Like it's the front end that kills you. Okay, I guess if you had to think about like an ideal age would probably be like 50 or a little bit younger. Okay.
Yeah.
And the reason for that is the first so many years you're putting that money in and you want it. The whole idea, remember, this is not about insurance. It's about growing tax free. It's about investing in like, private equity funds that are growing at a great rate is you want that cash value to grow dramatically. And the more that grows, the less insurance you need. So you have a higher amount of insurance that you need in those beginning years. So, it's the later years that you benefit from it. So I'm not saying that 65 is a deal breaker, but the ideal age is probably between, 48 and 62.
Okay. Ricky's asking too, could I just contribute to a traditional IRA, unlimited, non-deductible contributions and have it grow tax-free, but with lower fees than PPLI?
Wait, what do you mean unlimited?
Ricky, do you want to pop on and
how are you going to contribute unlimited? Like you can contribute into an IRA, but you can't contribute unlimited.
I think what he's saying is like, I don't see, is Ricky still here?
I mean, there's an IRA limit.
Yeah, yeah. I thought you could make unlimited non-deductible contributions to a traditional IRA.
No,
The
no,
limits from the IRS are to claim deductions, but then the non-deductible to do the backdoor Roth. That's what the IRS.
no,
So
no. You can't put $1 million into an IRA.
I thought you could, but non-deductible.
Nope.
Like
but not only that, but you're forgetting the biggest thing with an IRA. You're gonna have to pay, like it's not growing tax free, it's growing tax deferred. So when you pull the money out later, you got to get taxed on it.
Right, but the PPLI, right? If I want to pull it out, it's still going to be taxed, right? Just not up to its basis. So the basis comes out first in a life insurance policy, and then after the basis is over, then everything else gets taxed. The gross.
Well,
yeah, I thought the advantage of a life insurance policy was, you take out tax free up to the basis first.
Yeah,
like it's actually the first in is first out in terms of tax treatment, right? Right. And then the rest after you take out is taxed.
Yeah, but
like,
what you're saying,
up to basis.
Okay, but the thing I said